everybody? It's Bonds Day. I am fond of the bond. Let's go. So, welcome aboard. Today, what we are doing for you, free of charge. Can you imagine? Well, it's kind of free. It's free monetarily, but certainly not free in terms of your time. So we do plan on using your time wisely. We are going to learn about bonds issued at par, a discount, a premium, then a discount, also known as a zero coupon bond. We're going to do the effective interest method as well as the straight line. Why are we doing this for free? Everybody's chiming in with the questions. Why for free? Because we feel that you all have the right and deserve to choose your provider based upon your own personal experience. And it's not really the provider. How do you choose classes in college? It's the instructor. It's Megan. It's the support staff, Madeline. So we want to earn your business today. That's what we're all about, kind of show you what our notes look like, a little bit of our teaching style. Just as an FYI, what we're doing today is kind of like step one in the UWorld process. So the pre-recorded lectures walk you through the notes, etc. We then follow that up with your own multiple choice and task-based simulations that are embedded in the software, literally thousands and thousands of well-vetted questions with phenomenal detailed explanatory answers. Best in the business, no doubt. And then we have live online webinars where we actually do problem solving with you, whether it be multiple choice and or task-based simulation. But what you're seeing today is kind of what like you would see on the recorded lecture, okay? So let's jump in. I'm excited. I know Megan is excited. She has told us so. So our topic, go ahead, Megan, say hello, go ahead.
Hi. No, I'm just saying I love it. Like, I am excited for today.
Yep. Have you taken your medication today?
Not yet. Probably should have.
I haven't taken mine either, so I am jacked, baby. I am unusually jacked today. So topic for today, no notes. Notes, you got to buy the course. We can't give everything away for free.
Hey,
but
Pete?
bonds, what? Yes?
So sorry. I'm so sorry to cut you off there, but before we get started, I just want you to know that Megan and I are here in the background to answer your questions. Throw them into the chat, and we'll be happy to answer them with direct answers from us, but also we will be selecting some to ask Pete live within the presentation. So just letting you know, we're all here for that.
Love it. Thank you, Madeline. Yes.
Take it away, Pete. Take it away.
No worries. And Megan is a content expert, so she's the brains behind the operation. So Megan's going to be happy to take all your questions, content related, anything UWorld related, course related, policies, procedures, all that stuff. Madeline's your person. In addition, if you are at a university or a firm and you've got critical mass looking to study together, later on we'll be joined by Quinn, who's our national director of partnerships, specifically with the firms, but universities as well. But either Madeline or Quinn will address those issues as well. So bonds payable. We're also going to be looking at our journal entries. We want to know the difference between the interest expense versus the coupon paid. Why do we have a discount or a premium? Uh-oh, what did I do? What did I do? Why am I looking at myself? I don't want to look at myself. My screen went. Hold on.
I'm still seeing your screen.
Are you? And I'm not. That's not fair. There we go. So there we go. So why are bonds issued at a discount or a premium? The goal is to not have that memorized, but to understand why a bond would trade at a discount or a premium. We will not be doing trouble debt restructuring, but that is part of this topic, part of the AI CPA blueprints. So we're going to prepare those journal entries for the bonds payable. Before we do that, let's make a flashcard together. What you write, you will remember. So as a general rule, how are we going to calculate our interest expense? Tell me the carrying value of that liability at the beginning of the period. Multiply that by the market rate when the debt was issued. That is also known as the yield to maturity. All right, so that beginning carrying value times the market rate when the debt is issued, therein lies your interest expense, which we know goes on the income statement. All righty, so that's what you have on the income statement. Now, assuming it's not a zero coupon bond, tell me the par value of that bond. Also know the face value. Tell me what the coupon is. The coupon dictates the cash paid. There's your coupon paid. And under US GAAP, for my international students, there's no option. It's not like IFRS. Paying a coupon, that is operating outflow. If there's a difference between your interest expense and your coupon paid, that's due to this fancy term, amortization. Now, bright people like Megan love big fancy words like that. I don't. Amortize just means to record. All right, so we're going to be recording either where Madeline likes to go every Friday night, a discount. We're going to call that a disco. So that'll make the carrying value go up little by little over time as we record the discount. We'll see how that works. Conversely, if the bond was issued at a premium, we'll see how little by little we'll record that premium, amortize it over the life of the bond. Now, what is a discount? It's really a loss, folks. You sold a bond, the selling price is less than the face value. So you borrowed money, $1,000, but you didn't collect $1,000. You might have only collected $950. In English, that's a loss, right? You got to repay $1,000, you only got $950. So why don't we just book the loss immediately when the bond is issued? Why don't we just record the loss and be done with it? You can't, because that would violate the matching principle. So what we're going to do instead, we're going to implicitly record the loss by making the interest expense, as you're going to see, greater than the coupon paid. Little by little, we'll amortize, record that loss over the life of the bond. And as we record that, we will increase the carrying value of that liability so it moves up towards par, that $1,000. On the flip side, what is a premium? A premium is good news. It's a gain. You might have sold the bond for $920, yet the face value is only $1,000. So you mean to tell me, and let's make that $1,020, your selling price, $1,020. You borrow $1,020, yet you only have to repay $1,000. Yeah, that's right. That's a gain. Why don't we immediately book that as a gain? Because that would violate the matching principle. So how are we going to record that good news, that gain? By making our interest expense less than the coupon paid. Little by little, that'll make the carrying value of that liability move down towards that $1,000. So this is it. I mean, this is kind of like the whole shebang, all right? So I could shut it off right now, but pretty much what you write, more senses you engage. You write it, you read it, you hear it, you speak it, you're on a date, you talk about it. If your date's still there at the end of that date, you know you found your soulmate. All righty, so pictures now, you ready? We got the bondholder. So we're going to be lending, the bondholder will be lending money to the issuer. The issuer, folks, that is the borrower. That's going to be the corporation. So I'm going to show you journal entries from both sides because both are really testable. Whether you issue the bond, borrow the money, or you lend the money. All right, so we're going to see both sides of the coin. So the borrower, that's going to be the corporation. Okay, so that corporation issues the bond. Why do they issue that bond? Cash inflow, raising capital. On the statement of cash flow, what category does that go? Cash inflow, financing. All right, so when they issue that debt, we want to keep track of how much cash did they get? What's the face value? And is there a difference between the selling price and that face value? Okay, so we'll talk about that little by little as we do it. All righty, so we're going to have a mirror image, folks, of the bondholder, the lender, and the corporation, the issuer, also known as the borrower. So what is that mirror image? Pretty simple. As a general rule, what are we going to be looking at? Well, the issuer is going to debit their cash, credit that bond payable, assuming there's no discount or premium. Little by little over the life of the bond, we'll see they'll debit their interest expense, credit their cash. If you're the investor, well, it's the flip side of the coin. So if you're the investor, you're going to buy that bond, you're going to have an investment in bonds. You will credit cash, flip side of the coin. And then when they pay that coupon to you, you will debit interest, credit your interest income. All righty, and this is assuming the bond is issued at par, no discount, no premium. Okay, so we'll go through all those little details little by little. Journal entries are going to be important. We should be able to get those correct relatively quickly, saving time for the more math intensive, as you're going to see. The other thing is exam day. As you know, let's say you have on average 1.5 minutes a question. Some questions that are math intensive might take you closer to 3 minutes. But terminology like this, you got to get it right and get it right in 10 seconds because you need to save that time for the more math intensive questions that could take you, like I said, closer to 3 minutes. So a term bond, that's predominantly what we're going to be looking at. A single maturity date, all principal repaid at maturity. And that's what we'll be looking at here. But you need to know there's something called a serial bond. Serial bonds, they mature, the principal matures in stated amounts at regular intervals. So rather than paying all the principal at maturity, it's paid off little by little over time. A debenture backed by the borrower's general credit. So we hope they're going to pay us versus if it's collateralized, well, it's backed by specific assets, maybe receivables, property, plant, equipment, inventory, but something is pledged as collateral. That's security. So that if the borrower doesn't repay, the lender can seize those assets to pay off the loan. Registered, that's to a specific owner. Bearer bonds, not registered. Who's ever in possession is entitled to payment. A callable bond. What is a callable bond? You borrow money to buy a house. Right now, if you borrow money, interest rates are relatively high. You want the right as the homeowner. Should interest rates go down, you want the right to do what? Refinance. Callable bonds, similar for a corporation, though they're not borrowing the money to buy a house, they borrow money to finance their operations, but they want the right to call back that debt early should rates go down. That's called a callable bond. Who holds that right? The issuer. The borrower has the right to buy back the bond, pay it off early so they can refinance at today's lower rates. Conversely, if it's a convertible bond, that's at the option of the bondholder. They're thinking about buying the corporation's stock, but they're worried. Hey, what if the stock price tanks? So if you want to hedge your bet, you think the stock price might go up, but you're not sure, you say, okay, I want a floor on the value of this investment. If the stock price tanks, well, then at least you'll have the bond. So the bond acts as a floor on value. So what happens is whenever a bond converts, we take the carrying value of that liability, take it off the balance sheet from the perspective of the issuer, the corporation. If the bondholder decides to convert, well, there's no more debt outstanding. Instead, what are we going to give them? Stock. We don't get any cash, no change to assets. Liability goes down, equity goes up. We don't really do that in detail here. Sinking fund, you can repurchase. Who would do this? The corporation. Pay off the loan little by little at specified prices. You generally want to pay off your loan early in the event rates go down, or the lender might tell you, you know what, I want you to pay this off little by little over time because I don't want to be sweating it out 30 years from now to see if you're going to have the money to repay this debt when it becomes due. All right, so here's going to be the important items. Dates, just like depreciation, folks, watch those dates. When was the debt issued? There could be a difference between when the debt is issued versus the date of the debt. Okay, the debt is dated, so we're going to watch the dates. You're going to see. General rule of thumb, we'll either be paying interest annually or semi-annually. All right, so we'll read that as well. The other thing we want to look for, that coupon. That dictates the cash payment. Now, it doesn't have to have a coupon, but it usually does, okay? If it doesn't have a coupon, we call it a zero coupon bond. We want to see the face, the maturity value, okay? Now, when we find the selling price of the bond, the proceeds on sale, statement of cash flow, you're going to see that that's called a financing inflow again. We've got to find the present value of those coupon payments. The coupon payments are an annuity. It's an equal amount either once a year or every 6 months for the term, for the life of the bond. How do we find the present value? I want the present value factor for an ordinary annuity. General rule is the coupon's paid at the end of every year, at the end of every 6-month period. So present value factor for an ordinary annuity. Tell me the number of payments we're going to make over the life of the bond, and also tell me what the market rate is, okay? The market rate dictates the selling price of the bond. We also need the present value of a one-time principal payment at maturity. So again, you've got to tell me the term of the bond, and you got to tell me that market rate, and that'll help us find the present value factor of a one-time payment on that principal. Okay, now again, watch your dates, folks. We got the issuance date, we have the maturity date. This is going to help us determine the term of that bond, okay? So the term of that bond, number of years, and then if it's a semi-annual pay bond, we're going to want to take the number of years, multiply it by 2, and get the total number of periods, the total number of payments. We'll see how to do that. Okay, what dictates the price of the bond? The market rate, also known as the yield or the effective rate. Notice the synonyms. This is going to dictate the selling price of the bond. So this dictates selling price of the bond as well as the interest expense. In addition, the present value factors to find the proceeds on sale. So it is the market rate that will dictate the selling price, the interest expense, as well as our present value factors. So bonds payable, we know that that's a financing inflow. All right, so whoever issues that bond's financing inflow. Now, some of that payment could be due within the next year. If we have a payment due within 1 year, then that could be a current liability. Anything that's not due, the total due minus the portion that's the current liability, that's the remainder. That's our non-current liability. All right, so we back into that, no big deal. All righty, now the bond selling price, heavily tested. What's going to be our proceeds when we issue the bond? Again, I need the number of periods. I need my present value factors using the market rate. All right, using the market rate. Now, if it's annual pay, tell me the face times the coupon, there's your payment, there's your annuity. Okay, so that payment, therein lies your annuity. Tell me the yield to maturity. Come on, man, why does that keep switching on me? Sorry about that, folks. Why does that keep switching on me? Why is that switching on me? All right, so the face times coupon, there's your payment. The yield to maturity is also known as what? The market rate. Okay, and then tell me the term, the number of years. Very simple. Now, if it's semi-annual pay, read carefully. As soon as you see it's semi-annual pay, you're going to take that coupon divided by 2 when you get that payment that's going to be made every 6 months. When you look up your present value factors, you're going to take that market rate. You're going to divide that by 2 when you find your present value factors. And you're going to tell me the term, the number of years to maturity, times 2. That gets us the number of periods when we find our present value factor. All right, so the selling price is a function of 2 items. The interest payments, present value factor of an ordinary annuity, and the present value of the one-time principal payment at maturity, present value of 1. The sum of the 2, what's that? Our bond proceeds. That is our selling price. That is our cash received. So what I'm going to want you to always do, we're going to put that cash received right here, and the face value, our initial carrying value of that liability always has to equal the cash proceeds. And the initial carrying value may or may not be the face value, plus or minus any discount or premium. Okay, plus or minus any premium or discount if there is any. If there is no premium or discount, then the face value equals the cash proceeds, as you're going to say. Beautiful. Sweet stuff. So for the principal, what do we want? Present value of 1. That's the present value of the principal. Okay, now on the CPA exam, we could have the present value factor of an annuity due. That might be relevant. Generally, you see that more though with leases where the first payment is made immediately at the beginning of the period. That's generally not what we have with bonds, okay? What we're more likely going to have with bonds is the payment comes at the end of each period. But read carefully, they could do whatever they want. All right, so the present value of those coupon payments, the present value of those coupon payments, in a rare case, they might tell you the first coupon payment is made immediately, highly unlikely. You generally see that with leases. As a general rule with the bonds, payments come at the end of each period, okay? Remember, the market rate, also known as the yield to maturity, what does that dictate? The present value factors. We always use the market rate to get the present value factors. All righty. Read to see, is the interest paid semi-annually or annually? If it's paid semi-annually, what do we have to do? Take the coupon, divide it by 2. Take the market rate, divide it by 2 when we find our present value factors, and take the number of years times 2 to find the total number of periods, which is again what you need for your present value factors. Sweet. Interest expense. Remember, we are not cash basis, folks. We accrue, we record whether coupon is paid or not. It doesn't matter. We're going to record our interest expense whether or not a coupon is paid. All right, so in the period incurred, again, watch your dates. The coupon might be paid January 1 of the next year, but we may have to accrue for the interest at year end, December 31st. Why do we do that? Why do we accrue for it? Matching principle. We are not cash basis. We do not record the interest when the cash is paid, accrual basis. All righty, now, how do we do that? Carrying value of that liability at the beginning of that period. What do we multiply that by? The market rate at issuance. Now, that could be divided by 2. It all depends whether it's semi-annual or not, but that's how we get our interest expense. All right, and that's what goes on the income statement. The other thing we got to be on the lookout for, fraction of the year. What if the bond is issued? If the bond is issued on January 1, then yeah, we'll have 12 months of interest, assuming it's annual pay. But if the bond is issued February 1 in that first year, then we're only going to have 11 of those 12 months. If the bond is issued November 1st, then we're only going to have 2 months of interest expense. So watch those dates. Just like with depreciation, you buy that asset during the year, you're not going to record a year's worth of depreciation, okay? Forget about for tax purposes. I'm talking about accounting. All righty, so that's a little mini topic. How you liking it so far? Great stuff. Madeline, are you excited? Do you want to be a CPA now, Madeline? Does this excite you?
I am so excited, but you know what? I'm going to leave the CPA to all you. Thank you.
All right.
You've got this.
Bonds issued at par, folks. There's no discount. Sorry, Madeline, no disco for you, no premium, no math required. You don't have to do any math, as you're going to see when the bond is issued at par. Your selling price equals your par value, same thing as your face value, synonymous terms. Your coupon equals your market rate. Your interest expense is going to equal your coupon paid. Very, very simple. You're going to get these right, get them right quickly so you can save time for more math intensive questions. Folks, what I want you all to do, your fraction, you ready? This is the way you're going to learn whether it's a discount, premium, or par. Let's say we offer the world a coupon of 6%. The bond is examined by the market. They look at the risk and they say, you know what? 6% is a fair rate of return. When both your coupon, come on, man, why does that keep happening to me? That's not very nice. When both your coupon and your market rate are one and the same, when both the coupon and the market rate are one and the same, the bond will be priced at par. So if those two values are the same, that bond is issued at par value. Piece of cake. All right, here we go. January 1, year 1. Michigan company issued a 10% $1 million bond due in 4 years. Quickly becomes information overload. All right, the 10%, that is my coupon. My face value, $1 million. My term is 4 years. Now, the next thing I'm searching for is this annual pay or semi-annual. They tell me semi-annual. So what am I going to do with that coupon of 10? I'm going to take that 10%, divide it by 2. 5% is going to be what I'm going to pay every 6 months, 5%. Okay, my term gets multiplied by 2, 8. The next thing I'm looking for is what is my market rate? My market rate is also 10. So coupon divided by price, my market rate, 10, 10. Bond will be priced at what? Par. All of this distractor information, don't need it. Whenever the coupon rate equals the market rate, your selling price is going to be equal to the par value. So the par value is $1 million. My selling price is $1 million. Piece of cake. Assets equal liabilities plus equity. What's our cash inflow? $1 million. Financing inflow. What are we going to repay someday? $1 million. That's my bond payable. That's the carrying value of that liability. No discount, no premium. We're going to take that $1 million, the coupon divided by 2%. Coupon divided by 2. Coupon, too excited. 10% divided by 2. What's going to be my coupon payment? $50,000. That will also equal my interest expense on the income statement. $50,000. No discount, no premium. All principal is repaid at maturity. Let's test your short-term memory. What do we call a bond where all the principal is repaid at maturity? Term. All right, so no periodic principal payments. So on the exam, do we need this information? When your coupon equals your market rate, your selling price, your proceeds on sale equals your face value. We don't need to do any math. You could do the math if you got no family, no friends, no pet, no job, nothing else to do. Why not? So let's practice it. What if let's prove this to be true, that we're actually going to sell it and collect $1 million? Well, what would we do? Well, I would need my market rate. And since it's semi-annual pay, I'm going to divide that by 2. 5% is my periodic market rate. 4-year term, 2 payments per year, 8 periods. So now I need my present value factors. For the principal, for the $1 million in principal, that's the present value of a one-time principal payment of $1 million. For my coupon payments, the $1 million face value times the coupon divided by 2, 10 divided by 2, 5%. For my $50,000 payment, this is the present value factor of an ordinary annuity. We use the market rate, 8 periods. So when you find your present value factors, what do we need? The periodic market rate, and the number of periods, not the number of years, the number of periods. You need the number of years when it's annual pay. When it's semi-annual, tell me the number of periods, 4 times 2. So 4-year term, 2 payments per year again, 8. All right, and when you add that all up, what are you going to get? $1 million. You're going to get $1 million, okay? So the present value of your coupon payments, that's your annuity. So let's see our math. Ready? Here we go. Present value of the principal. What's present value of the principal? Your face value times the appropriate present value factor. Now, you know on the exam, they're going to give you multiple present value factors. They'll use the coupon rate for the present value factors. Cross that out. We don't use the coupon rate. They might give you the wrong number of years. Maybe they didn't take 4 times 2. They'll give you the present value factor for 4 years. No. When it's semi-annual pay, you got to multiply by 2. They might give you the market rate at 10%. Now, when it's semi-annual, we got to take that market rate, divide it by 2. So we got to have the right term and the right number of periods. Here's my present value of 1 for the principal, present value of the principal, and my coupon payment. Here's the present value factor of an ordinary annuity, present value of my coupons, add it together, and whoop, there it is. Your selling price equals your face value. But we don't need to do the math, but we just wanted to prove it to be true. All righty. So next issue, journal entries. You ready? What are we going to debit? As the issuer, we're going to debit cash. That is a financing inflow on the statement of cash flow. Assets are up. Initial carrying value of that liability. Liabilities are up by the same amount. No discount, no premium, piece of cake. Now, recording our interest expense and our coupon paid when the bond is issued at par. Coupon paid equals your interest expense. Period. Piece of cake. Carrying value, $1 million. No change when the bond is issued at par. It doesn't go up. It doesn't go down. Carrying value stays at $1 million. We multiply by the interest rate, 5%. Now remember, that interest rate, the coupon rate equals the market rate. So 5%, just make sure you remember semi-annual. There will be an answer choice trying to bait somebody who didn't divide it by 2. Your interest expense equals your cash payment. Interest expense income statement, cash payment. Statement of cash flow, specifically, again, my international students, no option under US GAAP when you pay interest. Not merely declare it, not merely accrue for it. It's got to be an actual cash payment, the coupon payment. If it's a 0 coupon bond, you don't see anything on the statement of cash flow for a 0 coupon bond because no coupons paid. So we're looking for the coupon payment, and under US GAAP, no options. That's an operating outflow. All righty, not so bad. So same amount when it's issued at what? Par. What else do we got? Carrying value does not change when the bond is issued at what? Par. Now compare that when a bond is issued at a discount. When the selling price is less than the face value, the carrying value of that liability is pulled up toward par over the life of the bond as we amortize, in English, record the loss. If the bond is issued at a premium, we scored. Our selling price is greater than the face value. We borrowed 1,000, but you know what? They gave me 1,050. So even though you only wanted $1,000 a bond, they gave you 1,050 a bond. Well, that's a gain. That carrying value of that liability will be pulled down towards par over the life of the bond. Sweet. June 30, year 1, bond is issued at par again. 10% market rate, 10% coupon. Your interest expense every 6 months for the next 4 years. Every 6 months for the next 4 years. 4 times 2, we're going to be recording 8 periods of interest. Exact same journal entry, 8 periods of interest expense. We debit our interest expense. That makes your net income go down. Your retained earnings will go down. Your equity goes down. Credit cash, that makes your assets go down. Balance sheet is in balance. Okay, and remember, this is an operating outflow. Operating outflow. So nice and easy. Same entry each period for the entire term. 4 times 2, how many times are we going to do this entry? 8 times over the life of this bond, assuming it is not called early. All righty. Now, what are we going to repay at maturity? At the end of the bond term, we call it a term bond, a one-time principal repayment at maturity. That $1 million, that will be financing outflow on the statement of cash flow, folks. That is financing outflow when you repay the principal. So be careful. A payment could consist of both principal and interest. The principal payment, financing outflow, the interest payment, operating outflow. Under US GAAP, no options. All right, baby, we're kicking ass. My dog is scratching at the door. Bella, you got to go away. I'm teaching a bond class over here, Bella. All right. You guys talk to your dog as well? Not a big deal. If my dog ever talks back to me, that'd be a big deal. What's a discount? That's a loss, folks. Why is it a loss? The selling price, the cash proceeds, the selling price, the cash proceeds, less than par value. All righty. Now, that is a loss, but why don't we book it as a loss? It would violate the matching principle. So what do we do instead? We will amortize it little by little over the life of the bond by making the interest expense greater than the coupon paid. Conversely, if the bond is issued at a premium, that's really a gain. Your selling price, your cash proceeds, you collect more than the par value, greater than your par value. But we can't book it immediately as a gain because that would violate the matching principle. So what do we do instead? We're going to make our interest expense lower than our coupon paid. And that's how we will little by little get that gain recorded on the income statement, okay? And then eventually the income statement ties to the balance sheet through our retained earnings. So no memorization, you ready? No memorization. A premium, how do we know we have a premium? Coupon divided by price, market rate. All righty, so we offer the world a coupon of 6%. They look at this bond and say, hey, this bond is great. There's high demand. They think, hey, you know what? I'd take this bond and I'd be happy with a 4% rate of return. 4 is less than 6. That means the bond is sold at a premium. There's an inverse relationship between the market rate and the price. If the market rate is lower than the coupon, down arrow, you know your denominator's higher. Okay, so we're going to sell that at a higher price. A premium is what again? A gain. Your selling price greater than the face value. What if we have a discount though, a loss? We offer the world a coupon of 6%. They look at this bond and they say, no way. We want more than 6%. Hey, we want 8%, more than that 6. Well, then what's going to happen to the price of that bond? It's discounted. So if the market rate, that yield is greater than the coupon being offered, you know what? Price is going to be discounted. We can't change the coupon. That's stated in the instrument. So the only way we could get the market that higher rate they want is the price is discounted, okay? The way you get your actual yield is the cash flow divided by the actual selling price. When your selling price is less than the face, that is bad news. That is a discount, baby. So that's the way you're going to do it. All right, here we go. January 1, year 1, we issued a 10%. There's my coupon. $1 million. There's my face value. 4-year term. What's the next thing we're looking for? Annual pay or semi-annual? I see it's semi-annual. I take my 10% coupon, divide it by 2. My periodic coupon, 5%. While the bond only has a 4-year term, 2 payments per year, how many periods do we have? 8 periods. Okay, the interest is paid June 30, December 31, but the market wants a rate of 12. Stop everything you're doing. If this is the exam, coupon divided by price, your yield. We offer the world, you can do it annual or semi-annual, just make it annual. We offer the world a coupon of 10. The market looked at this bond and said, no way, we want 12. So I'm immediately thinking this bond is selling at what? A discount. My selling price has got to be less than that par value, making my interest expense going to be greater than the coupon paid. You stop and you think, you don't memorize. We understand it. When they demand more than what you've offered, the price will be discounted. Okay, with a market rate of 12, we got to divide that by 2. My periodic market rate is 6%. I need my present value factors. Folks, your present value factors are based upon the market rate and the number of periods. The market rate, 6%, we got to divide it by 2, and my number of periods is 8. There will be present value factors using the 12% and 4. Nope. And we got to make sure present value of the principal, that's a one-time payment. That's the present value of the principal. So that gets multiplied by $1 million to find the present value of the principal. My coupon payment, the 1 million times the periodic coupon rate, 5%, that's $50,000. This is my present value factor of an ordinary annuity. That present value factor gets multiplied by $50,000. So we want the market rate and the correct number of periods. Now you do your math. What's the present value of the principal? 627, 412. What's the present value of those 8 coupon payments? 310, 490. Now look, we've already set ourselves up. We better get something less than $1 million or we screwed up. You got to get a price of less than $1 million. Did we get a price less than $1 million? Yes, we did. 937, 902. Boom, there it is. Now, I want you to understand, journal entry will come in a second, but balance sheet, we just got cash of 937,902. But what do we have to repay someday? The $1 million face value is what we got to repay someday. Your initial carrying value, folks, always has to equal the cash proceeds. Your initial carrying value of that liability has always got to equal what? Your cash proceeds. Now, what is the difference between the $1 million and the 937,902? What is the difference? That is your discount. $62,098. That's currently unrecorded, unamortized discount. All righty. Now, why don't we just book the $62,098 immediately as a loss? Because Megan would get pissed because she loves accounting and she'd be like, oh, in her Texas accent, oh, what are you doing over there? That's a discount. You can't immediately book that as a loss. That would violate the matching principle. So instead, the interest expense every period is going to be greater than the coupon paid. While my periodic coupon rate is 5%, my interest expense is going to be recorded at 6%. Little by little, we'll record that loss over the life of the bond by making the interest expense greater than the coupon paid. That is the amortization, the recording of the discount. Now, little by little, as the unrecorded loss goes down, every 6 months as we record a little piece of the loss, as the unrecorded loss goes down, what's going to happen to the face value? It's going to get pulled up towards par. Megan, how'd you like that? How was my imitation of your Texas accent? Did I do a good job?
So I live in Texas, but I'm from the East Coast. But on the accent, I would say that was sort of more New York than Texas. Like, we're going to have to work on your twang. Maybe a couple of y'alls in there for us.
Y'all? Come on, man. All right. So
or all y'alls, if you mean everybody.
No, I love it. I love it. I love it. You know what? When Megan says, hey, when Pete's on the video, she wants there to be captions at the bottom as if I'm speaking a foreign language. She says she could barely understand me with my New York accent. All right. Present value factor is always based upon what? Market rate and the number of periods. Just make sure 12 gets divided by 2 because it's semi-annual, and make sure those years get multiplied by 2, 8. Present value factor for the principal, one-time payment. Present value factor of an ordinary annuity for your coupon payments. Wait, principal, 627. Present value of the coupons, 310. Here's your cash proceeds. As predicted, less than the face value. Why? Because coupon divided by price, your yield. You offer the world 10. They said, no way, we want 12. That means your denominator has got to be lower. Okay, selling price less than $1 million. We got it, we got it, we got it. Now, my coupon payment. How do we get the coupon payment? Well, your coupon payment is the $1 million face value times the 10 divided by the 2, 50,000. Now watch your dates. A full 6 months because the bond was issued on January 1. All righty. Now that's not my interest expense though. What's my interest expense going to be? You ready? Beginning carrying value of that liability, 937,902 times the market rate, 12 divided by 2, periodic, 56,274. You mean to tell me on the income statement we're going to have interest expense of 56,274, yet on the statement of cash flow we're only going to show a $50,000 payment? That's right. What's the other $6,274? We just recorded a little piece of that loss. We just recorded a little piece of that loss. How much of that loss just got recorded? Well, we don't say loss recorded. Why don't we just say loss recorded? Because PhDs like Megan want to charge their clients a ton of money. So the PhDs, the super smart people like Megan, they make up their own language. So they're not going to say, oh, we're recording a little piece of the loss. Nah, they're going to say, hey, we just amortized some of the discounts. See, they got their own code language. $6,274. What happens to the carrying value of the liability over time? It gets pulled up towards par. So while the carrying value of that liability was $937,902, no more, we just amortized how much? $6,274 of that loss. The carrying value of that liability, little by little, every 6 months for the next 4 years, pulled up towards par. Whoop, there it is. All righty. So that's $62,098. That discount is really a loss that will be recorded little by little. How do you like that language? Little by little over life of bond. We make that interest expense greater than the coupon paid. So that's it. That's the matching principle. So journal entries, you ready? January 1, year 1. Debit cash, assets go up. Now the discount, this is interesting, $62,098. That has a debit balance, and that makes the carrying value of that liability lower than the face value. Nothing to memorize. Remember, the carrying value of that liability has to be less than the face value. The bond payable, your face value, that makes your liability go up. So our balance sheet is in balance. Assets are up by how much? 937,902, and the net carrying value of that liability, 937,902. The $1 million minus the currently unrecorded 62,098, 937,902. Now, little by little over the life of the bond, as we subtract a smaller and smaller unrecorded loss, what's going to happen to the carrying value of the liability? Be pulled up towards par. All righty. Now, from the bondholder perspective, the mirror image. Remember that bondholder? Well, they're going to debit investment in bonds. What's their investment in bonds? Assets go up. Face value, $1 million. Okay. Now, they're going to have a discount on the bond that they bought. That's good news from the bondholder standpoint. That's a discount. Hey, they bought $1 million asset for only $937,902. So they credit cash $937,902. This is your plug figure, $62,098. Okay, so investments in assets go up. Investment in bonds, that's a non-current asset, goes up. Non-current assets go up. Cash, a current asset, goes down. So total assets, no change, just a change in form. So the non-current assets are up by 937,902. The current asset, cash, you're less liquid now. Total assets, no change, just a change in form. So we got the flip side of the coin. All righty. So from the borrower's perspective, the borrower, also known as who? The issuer. My loss, the unamortized discount, will be recorded little by little over the life of the bond, pulling up the carrying value of that liability toward par as we amortize that discount. All righty. Now, in this example, new set of facts. We issued a 10% coupon, face value, $1 million, 4-year term. What are we immediately looking for? Annual pay or semi-annual? What do I see? Semi-annual pay. So I immediately stop and say, although my coupon is 10% divided by 2, my coupon payment, that'll be 5%. 4-year term, 2 payments per year, and the total number of periods is 8. Okay, they tell me the market rate is 8. Stop right there. Coupon divided by price, the market rate. We offered the world a coupon of 10. They looked at this and said, hey, we'll be happy with 8, lower than the 10. So that means my denominator is in the opposite direction. My selling price better be greater than the par value or I did something wrong. And my interest expense is going to be less than my coupon paid. I'm anticipating a gain. All right, so now I need my present value factors. What dictates our present value factors? Our market rate, 8 divided by 2, 4%, and our number of periods, 4 years times 2, 8. So now I'm looking for present value factors. Present value of 1 for my principal, present value factor of an ordinary annuity for my coupon payments. So I'm anticipating I better get something more than $1 million or I screwed up. Present value of $1 million. Let's see. That gets me 730, $690 using these present value factors. My coupon payment, $50,000. My $1 million times the 5%, $50,000 payment. So there is my coupon payment, present value of those payments, $336,650. Sum of the two, $1,067,340. Did we get something more than $1 million? You bet. We did it right. You know you did it right. Now we're thinking big picture. Hey, I just got $1,067,340, yet I only have to repay $1 million. We kicked ass. This is a gain. You mean to tell me I borrowed $1,067,000 and I only got to repay $1 million? Yup. Your initial carrying value, folks, always has to equal what? Your cash proceeds. So your initial carrying value has got to equal your cash proceeds on sale. So what's the difference? $67,340. That's unamortized. Smart people like Megan use these fancy words because they want to charge their clients. What do you charge, Megan, an hour? What do you charge for your services? What would you last tell me? Like $2,000 an hour? What do you get?
Practically something very close to that. Yeah.
Very close. You know, dinner's on Megan. Dinner's on Megan. She's got the cash. I'm still driving a Ford Pinto.
I mean, it's styling now. What's old is new again. It's a
Yes,
class.
yes, I like that. So the other unrecorded gain, folks, little by little, we're going to record this gain. How are we going to record this gain? My interest expense is going to be less than the coupon paid. My interest expense periodic is the 4%, the 8 divided by the 2, 4%, but every 6 months, my coupon paid is 4. What's the difference? The amortization, the recording of the gain. Since your interest expense is less than the coupon paid, that's good news. As the unrecorded gain shrinks, as we start amortizing the gain, what's going to happen to the carrying value? It's going to be pulled down towards par over the life of the bond. Okay, as we amortize, the amortization is the difference between the interest expense and the coupon paid. So what dictates our present value factors? The market rate. The market rate, just make sure you divide by 2. All right, they're going to try to get you with the 8. It's not the 8, it's the 4. They're going to try to tell you 4 periods. It's 8 periods because it's semi-annual pay. Present value factors dictated by the market rate as well as the correct number of periods. Okay, present value, the principal of one-time payment in the future. Present value of an ordinary annuity for your coupon payments paid every 6 months for the next 4 years. So present value of the principal plus the present value of the coupon payments, we get $1,067,000 greater than the face value. We anticipated that. How did we anticipate that again? Because the market said we'd be happy with 8. You offered 10. Hey, we'd be happy with a lower number, par value. We're going to get more than par value. And anytime it's good news, when it's a gain, we don't want to violate the matching principle, so we simply record the gain little by little by making the interest expense at the market rate, periodic market rate, less than the coupon, 5%. Sweet. All righty, now crunching the numbers, you ready? We've got a $50,000 payment, $1 million times the 5%, the 10 divided by 2, we got a $50,000 payment. Greater though than my interest expense. My interest expense, how do we do that again? Initial carrying value of that liability, beginning of the period. Carrying value of that liability, beginning of the period, $1,067,327. Your market rate, just make sure periodic 4% times your market rate, periodic 4%. My interest expense is only going to be $42,693. So wait a second, we're cutting a check for $50,000, yet my interest expense is only $42,693. $42,693. What's the difference? We just recorded, we just amortized, we just recorded a little piece of that premium. We just recorded $7,307. What's going to happen to the carrying value of that liability? It's going to go down. We're going to subtract that $7,307. And what happens to the carrying value of the liability? It's going to be pulled towards par. it's going to be pulled down. So that's how you know to subtract the amortization of that premium. The carrying value's always got to move towards the par value over time. Nothing to memorize. Okay, so we had a gain. We implicitly record that gain by making the interest expense less than the coupon paid. That adheres to what principle? Matching. We can't immediately, because some people say, wouldn't it be so much easier to just do this? Record your cash of $1,067,000, record your liability, and just put $67,000 right into equity. Like, why don't we just do that? You know, why don't we just do that? Your balance sheet's in balance, because this would violate the matching principle. I can't immediately put that into earnings, into equity, violates the matching principle. All righty. I mean, if I tried to do that, Megan would be very upset. You know, because I tried to argue, why don't we just do that, Megan? And she said, Pete, if you do that, I will stab you right in the eye with my pen. She said that to me. Texas and everything.
Pretty violent like that.
What happened?
A lot of aggression. I am violent like that. Very aggressive.
That's a little bit more than I wanted to know. Now I'm a little bit afraid of her. All right, so we debit cash, assets up, financing inflow. I credit my bonds payable for my face value, $1 million. What's your plug figure? We got to make our journal entry balance, $67,327. A premium has a credit balance. It makes the carrying value of that liability go up. All righty, so my assets are up. The carrying value of my liability is up by the same amount, $1,067,327, right? It's got a balance, or your premium or your discount, that's your plug figure. So on our balance sheet, little by little, as we record this gain, little by little, the unrecorded amount goes down as you add a smaller and smaller number, carrying value liability pulled down towards par. Let's do it, baby. All right. Now, effective interest method. How do we actually crunch the numbers for the amortization every 6 months? So this is what most people, there's no big deal. You want this on the exam because you're going to get it right in a TBS and you're going to get it right quickly. You will know inside and out, my coupon paid, assuming it's not a zero coupon bond, is constant over the life of the bond. It is the face value times the coupon, or the coupon divided by 2. If it's semi-annual paid, there's your cash payment. Your interest expense on the income statement. That's what's on the income statement. That'll be the beginning carrying value of that liability times the market rate, or the market rate divided by 2 if it's semi-annual. There's your interest expense. Any difference between the two is amortization. That is the effective interest method. Okay, the effective interest method. All right, amortization is a fancy term. That is the difference between coupon paid, which you'd see on the cash flow statement, versus whoops, whoa, take it easy. What's going on over here? What is that all about? Come on, man. What's going on? Why is this thing bugging out on me?
I think GoToWebinar is glitchy today.
You know what, man? That's not nice. There we go. There we go. Interest no. Oh, I see. I'm touching things down here. All right. Interest expense on the income statement. That's what amortization is, folks. The difference between the interest expense on the income statement and the coupon paid. All righty. Amortization, when you amortize a gain, the premium, when you amortize that, you got to pull the carrying value of the liability down towards par. When you amortize a loss, a discount, carrying value of the liability goes up. All righty. So it's a matter of repetition, folks. Speak it, write it. You will think on the exam rather than memorizing, okay? You're just going to use logic because you're going to know how to solve it. All right, discount, loss, premium, gain. All right, we're going to record. Amortize means to spread it out over the life of the bond so we adhere to the matching principle. All righty, remember, at maturity, the carrying value of that liability's got to equal what? The face value at maturity. So everything gets pulled towards par. We amortize, record the discount or the premium over the life of the bond because we are accrual basis matching principle. All righty, so we don't want to record that gain or loss in the year we issue the bond. That would violate the matching principle. Now, there's two ways to amortize. One of two, which I'll show you first, the effective interest method. Okay, that's known as a constant rate of amortization, constant rate, all righty, versus two of two, straight line method, but that's allowed only if it's not materially different from the effective interest method. I'll show you that in a little while. Straight line, we have a constant dollar amount of amortization. I'll show you how that works. Okay, we'll take that discount or that premium. We will divide it by the number of periods, and that is straight line, the constant dollar amount of amortization of that discount or premium. Okay, we'll see how to do that in a little bit. All righty, now, whoa, graphs, what the hell's going on here? You ready? No big deal. Here's the selling price of the bond. Eventually, we're going to be at maturity. If the bond is issued at a discount, the carrying value of that liability is less than the face value. Little by little, that gets pulled up towards what? Par. At maturity, the carrying value of that liability will be what? Par value. So the carrying value gets pulled up little by little over time, okay? It's pulled up towards par. Pulled up towards par, okay? Anytime we have straight line amortization, if it's straight line, just like depreciation, we're gonna have a constant amount of interest expense. You're gonna take your discount, your loss, divided by the number of periods. That's your straight line amortization. You add that to the coupon paid, because my interest expense has to be greater than the coupon paid when it's a loss. All righty, so you're going to take the discount divided by the number of periods. That's your straight line amortization. You add that to the coupon payment. That's a constant dollar amount of interest expense. Okay, a constant dollar amount. So anytime we have straight line, constant amount. What if we're doing the effective interest method instead? Well, either way, the carrying value gets pulled up toward par over time. So eventually it'll be at par value. When is it going to be at par value? When it's at maturity. But notice the interest expense. It's not a constant amount. Not a constant amount. The interest expense goes up. As the carrying value of the liability goes up, the interest expense goes up with it. It is not a constant amount. Constant rate. Effective interest method is a constant rate. All righty. How do we get interest expense? Tell me the carrying value of that liability times the market rate. That's constant. The market rate when the bond is issued, and that's how we get our interest expense. So if your carrying value is being pulled up, so is your interest expense. Easiest understood as we apply it, but the visuals here, they do a great job illustrating what that looks like visually. Okay, now let's go back to the effective interest method, the general rule. Okay, how do we calculate our interest expense? Tell me the beginning carrying value of that liability, beginning of that period. Multiply that by the market rate at issuance. All right, and that could be the market rate divided by 2, or the market rate depending upon whether it's annual or semi-annual. Now be careful, there's one more piece of the puzzle. Watch your dates. Watch your dates. All right, how many months was this bond outstanding? Okay, so the number of months that bond is outstanding divided by the total. Okay, we'll see how to do that. All right, so then the dates are going to come in just like with depreciation, no big deal. Okay, so the beginning carrying value of that liability times that market rate, there's your interest expense. Okay, if the bond is issued at a discount, our interest expense is going to be greater than the coupon paid, or we did something wrong. A discount is bad news. The expenses are higher. Okay, if, however, the interest expense is less than the coupon paid, if that's less than the coupon paid, then we know we have what? A premium. Okay, a premium. All right, bond was issued at a premium. Now remember, the carrying value of that liability, if the bond is issued at a premium, if your selling price is greater than the face value and you have a gain, carrying value of that liability greater than the face value, well, what's going to happen to the carrying value of that liability? It's going to be pulled down over time. So your interest expense is also going to be pulled down over time. Okay, remember, effective interest method, constant, not dollar amount, but a constant rate to calculate interest expense. It's the market rate when the debt was issued, the market rate when the debt was issued. Okay, so on the exam, this makes for a great task-based simulation. Can you do a partial or a full amortization schedule? Not for 8 periods, but maybe 2 or 3 periods or so. So it makes for a great task-based simulation. So discount, we know our interest expense is going to be greater than our coupon paid. Premium, good news, we know our interest expense is going to be less than our coupon paid. So beginning carrying value of that liability plus the discount that gets amortized, the ending carrying value of that liability is going to get pulled up. Beginning carrying value of that liability minus the premium that gets recorded, the ending carrying value of that liability is going to be pulled down over time. All righty, so the carrying value always moves towards par. Remember, effective interest rate, the market rate, the rate at issuance, that does not change. That is constant. Okay, the interest expense, though, is always a function of the carrying value. If the carrying value of that liability is getting pulled up, your interest expense will get pulled up. If the carrying value of that liability is being pulled down, your interest expense is going to be what? Pulled down. All righty. So let's crunch some numbers. We're not doing notes. I know you want to do notes. Unfortunately, just the bonds. All right. So now let's apply it to a discount loss. We sold it. Our selling price is less than our face value. Our interest expense is going to be a function of the coupon paid plus the amortization of the discount. How do I know that? Because the interest expense has got to be greater than the coupon paid alone. That's how I know I'm adding the bad news to the interest expense to implicitly record the loss over the life of the bond. How do we know the bond is issued at a discount? Because the market is demanding a rate higher than the coupon. If they want a rate higher than the coupon, the only way to do that is to do what? Discount the price. All righty, so amortization of a discount, a loss, that interest expense has got to be greater than the coupon paid. All right, so how do we calculate? Beginning carrying value times the effective interest rate. All right, going to be greater than the cash interest payment, face value times the stated coupon. The amortization, take your beginning carrying value of that liability, and we want to pull that up towards par. Ending carrying value of that liability is going to be pulled up. Okay, so as we record the loss, because my selling price was less than par value, we know, we don't have to memorize, the carrying value of that liability has got to be pulled up. Okay, when it's bad news, your interest expense is greater than the coupon payment. Okay, so the unamortized discount is a contra account. Okay, reduces the carrying value of that liability. We don't have to memorize. Reduces carrying value of that liability. It's a contra account. The unamortized portion, if you get a little bit nervous exam day, just think, hey, I issued a bond for $970. The face is $1,000. Oh yeah, my initial carrying value is $970. $1,000 minus the $970. What is that? Oh yeah, that's unrecorded, unamortized, unrecorded loss. As we record that little by little, what happens to the carrying value? Gets pulled up towards par. You don't need to memorize anything. Use the word loss. Loss is bad news. The interest expense greater than the coupon paid. Okay, so by amortizing the discount, the unamortized portion goes down so that the carrying value can go up. Eventually at maturity, the carrying value's got to be equal to what? It's got to be equal to face value. All righty. So when a bond is issued at a discount, interest expense is going to go up as the carrying value of the liability goes up under the effective interest method. Effective interest method, we don't have a constant dollar amount, we have a constant rate to calculate our interest expense, the market rate at issuance, that market rate at issuance. Okay, so as the carrying value of the liability goes up, interest expense is going in what direction? Up. It is not a constant amount. Okay, so interest expense, not constant under effective interest method. It is not constant under that effective interest method. All righty. So interest expense is going to be greater than the coupon paid. All right. The coupon payment, the face amount times the coupon probably divided by 2. There's your operating outflow. Your interest expense, your beginning carrying value of the liability times that market rate divided by 2. There's your interest expense. The plug figure is the difference between the two. That's it. You got to make sure your balance sheet balances. Okay, as your contra liability goes down, as the unrecorded loss goes down, the carrying value of the liability is going up. As the unamortized, as the unrecorded loss goes down, carrying value of the liability goes up. Okay. Interest expense appears where? Income statement, US GAAP. Where does the cash coupon payment go? Operating outflow. Your interest expense is going to be greater than that coupon payment. To make our journal entry balance, we plug the discount. Okay. Total interest expense over the life of the bond. That's interesting. That's the sum of the cash interest paid. Take your periodic coupon payments times the number of periods. There is your cash interest paid, plus the discount, the original discount when the bond was issued. A discount is really a loss, but we can't book it as a loss, so implicitly we're recorded over the life of the bond by adding it to the interest expense. That's how you get the total interest expense over the bond term. Okay, so it's the sum of those two items. All right, let's take a look at an example. You ready? January 1, year 1, here's my coupon, 10%, $1 million, due in 4 years. The interest is paid how often? Semi-annually. So we take the 10% coupon, we divide it by 2, 5%, times the $1 million. What's my payment? $50,000 payment every 6 months for the next 4 years. 4 times 2, number of periods, 8. All righty, we offered the world a coupon of 10. The market wants more than that. They want 12. So the price is going to be what? Discounted. All righty, so present value factors, 12 divided by 2, 6. Number of periods, 8. We get our present value factors. We get the present value of the principal plus the present value of the payments. That is our selling price, and we're anticipating a selling price of less than the par value of $1 million. We got $937,902. So I'm thinking when I issued the bond, I got cash of $937,902, but someday I got to repay $1 million. My initial carrying value has got to be equal to what? The selling price. The difference between the two, that is my unrecorded loss. Little by little, as I record the loss, the carrying value will be pulled up towards par. We're all set up, nothing new there. All righty, so here we go. You ready? Initial carrying value of the liability, $937,902 times my market rate, 12 divided by 2 because it's semi-annual pay, $56,274. That's my interest expense, greater than my coupon paid of $50,000. What's the difference? $6,274. That's a little piece of the loss of the $62,000 loss. The unrecorded loss, I just recorded $6,274. That's amortization. We know we have to add that because the carrying value's got to be pulled up towards par. at the end of, in 6 months, what's our carrying value? The 6 months from now, the carrying value would be 944,176. As the carrying value goes up, what's going to happen to our interest expense? That's going to go up as well, right? 56,000 now, 651, greater than the coupon paid of only 50,000. So what do we have now? Amortization, 6,561. Amortization. What do? Add it to the carrying value, 6,561. In 12 months, what's going to be the carrying value of this bond? 950,827. Multiply that by your market rate over 2. There's our interest expense. Interest expense is going to be greater than 56,651, and so on and so on and so on. There you go. You're an expert. Task-based simulation. You're going to rock it. You're not going to just get it right. You're going to kick ass. You're going to get it right, and you're going to get it right quickly, saving time for things that are more difficult. All right. So our carrying value is going to be pulled up towards par. The market rate is constant. We have a constant market rate. 12 divided by 2, 6%, no change. Beginning carrying value times that market rate. What does that get us? Our interest expense. As your carrying value goes up, your interest expense goes up with it. Cash payment, constant, no change. That's at the 5%. So my interest expense greater than my coupon. 56,274 minus the 50. Amortization. 937,902 was my carrying value. I just added 6,274. What's my balance now? 944,176. We repeat the process over and over again. This is not a big deal. Now we got 944,176 times the constant rate, no change. Carrying value goes up, interest expense goes up. Coupon does not change. 6,561, excuse me, 6,651. We have a new carrying value, 958.27. Carrying value goes up times the constant rate, no change. Interest expense goes up, coupon payment, no change. Add the 7,050. What's happening to our carrying value by liability being pulled up such that at maturity, 4 years from now, at maturity, what's the carrying value of the liability got to be? Par value. And then we have a financing outflow, a one-time repay principal. That's why we use the present value factor of 1. It's a one-time payment, 8 periods from now, 4 years from now. All righty, so what's our journal entry? You ready? Interest expense. We debit interest expense. That'll make your net income go down, which will make your retained earnings go down. That'll make your equity go down. 56,274. Cash paid, 50,000. What's our plug figure? Well, my interest expense is greater than my coupon paid. Oh yeah. The difference is the amortization. As your contra liability goes down, the carrying value of the liability goes up. Our balance sheet is in balance. How is it in balance? $50,000, cash is down. Liabilities are up by 6,274. Equity is down by 56,274 due to the interest expense. The right-hand side of the balance sheet down by 50,000. We're in good shape. Notice the date, folks. Full 6 months. You'll see why that's important in a little while, but a full 6 months. Flip side of the coin now. 2 for 1. You ready? Buy one, get one free. What if you're the bond holder? What's your journal entry? Well, you're going to get a check for $50,000. You're going to debit cash. Yet your interest income is not $50,000. Your interest income would have been $50,000 had you bought the bond at par. But because we bought it at a discount, your interest income is greater than the coupon received. So your interest income is going to be greater than the coupon received when you buy the bond at a discount. So your interest income is $56,274. Well, my journal entry doesn't balance. How do we make it balance? Oh yeah, discount just got amortized. There's your plug figure. We debit $6,274. All righty. From the bondholder's perspective, the carrying value of their asset is being pulled up towards par. Whereas from the borrower's perspective, the carrying value of the liability is being pulled up towards par. We're kicking ass, baby. I don't know if you feel it, but I'm feeling it. Madeline, what are you feeling right about now? You feeling it?
I'm feeling it, Pete. This is a great Saturday morning. Love it.
Come on, man. What don't you feel bad for people, their family and friends right now? Probably sleeping in, drinking late last night, destroying their brain cells. You're here enriching your mind. Just think about all that money you're going to make after you're a big time CPA like Megan, right? Think about the big house, the nice car, the Lamborghini she's got, all the drugs you can afford. Pharmaceuticals only.
Okay.
Legalize. Oh, Ozempic. You see what it's doing for me? You see this, man? I lost 20 pounds.
You look great, Pete.
Oh, where do I send the check? All right, ready? Interest expense, second period, 12 months from now. Here we go. Interest expense went up because the carrying value of the liability went up. It's now 56,561, but we're still cutting a check for $50,000. So from the borrower's perspective, contra liability down, carrying value of the liability being pulled up towards par, liabilities up, liabilities down, assets down by 50,000. What's the net change to our liability? Net change to our liability and equity, liability and equity. Equity is down by 56,651. Liabilities are up by 6,651. Our balance sheet is in balance. Right-hand side of the equation, down by 50,000 as well. Okay, right-hand side equals the change in the left-hand side. Assets down by 50,000. Liabilities and equity net change 50,000. Equity down by 56,251 due to the interest expense. And then the liabilities being pulled up towards par, so that's going up. Net change 50,000. Okay, now let's talk about same thing, but now let's do a premium. All righty, so now with a premium, the carrying value of that liability, little by little, be pulled down towards par. Tell me what that is at the beginning of the period, times that market rate, probably divided by 2 if it's semi-annual pay. Your interest expense is going to be pulled down. Now, a premium is good news. That's a gain. So the coupon paid minus the amortization of the good news, that's going to make your interest expense less than your coupon paid. Take your coupon paid, but we subtract the good news. We reduce the interest expense so that we can record that gain. Remember, the interest expense has got to be less than the coupon paid when that bond is issued at a premium. You write it, you read it, you speak it, you'll remember it. Okay, how do I know the bond was issued at a premium? We offered the world a coupon of 8. They looked at our bond and said, hey, we'd be happy with 5%. Hey, good news. We're going to get more than what we bargained for. Selling price is going to be greater than the par value. That carrying value will be pulled down toward par. All righty. How do we get the cash payment? That's always your face value times the coupon. How do we get the interest expense? That's the carrying value beginning of the period times your effective rate. The difference between the two, we are recording the gain. All righty. So take the beginning carrying value of that liability. You subtract what you recorded, the good news. The ending carrying value of that liability has got to be pulled down toward par. Pulled down towards par. Remember, effective interest method, the interest expense, the dollar amount changes, but the rate is constant. As the carrying value of the liability goes down, the interest expense under the effective interest method is going to go down as well. The rate is constant, but not the dollar amount. So on the exam, you think, if you get a little bit nervous, it's a theory question. Remember the numbers from our example. My selling price, $1,067,000, yet the face is only $1 million. Well, my initial carrying value's got to be what? $1,067,000. Your initial carrying value has always got to be equal to the cash proceeds. All right, so then how do I get this? Oh yeah, I got to add 67. That is unrecorded, unamortized gain, unrecorded gain, premium. Little by little, as I record that, my carrying value be pulled down towards par. Whenever you see it's a gain, you're thinking gain, good news. The interest expense has to be less than the coupon that I paid. All righty. The unamortized premium, a gain that has a credit balance. The unamortized gets added. It has a credit balance, an adjunct account. The carrying value, we got to add the unrecorded gain. As that shrinks and we add a smaller and smaller number, carrying value pulled down. How do we record the gain? Little by little, we amortize it by making our interest expense again less than the coupon paid. The unrecorded amount decreases over time. As the carrying value of the liability goes down, your interest expense will go down with it. At maturity, what do? We repay the principal. The carrying value will equal the face value. How do you know you're looking at a premium? How do you know what's happening to your interest expense over time? It's going down. As the carrying value of the liability goes down times that market rate, your interest expense is going down with it. The carrying value decreases, so your interest expense decreases. How do you know you're looking at the effective interest rate? The effective interest method. Because the interest expense is not constant. If the interest expense is moving with the carrying value, you know that's the effective interest method. Straight line method, your interest expense is a straight line, whether it's year 1 or year 4, it doesn't matter. Straight line, your interest expense dollar amount is constant, okay? And we'll see that in a little bit. All right, journal entry. You're going to record your interest expense. That'll make your net income go down, your retained earnings go down, your equity go down. Your interest expense is going to be less than the coupon paid. Your coupon paid, that'll make your assets go down. Your plug figure is to make your journal entry balance. The carrying value of that liability is going to go down as you amortize that gain. So interest expense, income statement, coupon paid, statement of cash flow. Why is that important? Task-based simulation, folks. You might get financial statements. You find the interest expense, obviously, on the income statement. You find the coupon paid on the statement of cash flow. The difference between the two is the amortization. In this case, the interest expense will be less than. This is our amortization, the way we would back into it. Okay, the recording of that gain. Good news. All right, total interest expense now. Just like we did before, we start with the cash interest paid. The coupon payment times the number of periods. That's the total cash paid for interest. But again, premium, again, that makes interest expense go in what direction? Down. So we don't add it, we subtract it. Tell me the premium when the bond was issued. When the bond was issued, it's good news. So that makes your interest expense go down. Gains are good news. All righty. Crunching our numbers. January 1, year 1, issued at 10%. That's my coupon. 10 divided by 2. Why? Semi-annual pay. 5% times the 1 million. What is my coupon payment? $50,000. While it's a 4-year term, 2 payments per year for a total of 8 payments. We offered the world a coupon annualized of 10. The market said, hey, man, we love your bond. We'll accept a lower amount. Selling price has got to be greater than the face value. All righty, so my present value factors, I need the 8 divided by the 2, market rate 4%, 8 periods. I get my present value factor of 1, plus I get my present value of my payments, ordinary annuity, my selling price, $1,067,000. That's got to equal your initial carrying value, $1,067,327. So we have unamortized, currently unrecorded gain of $67,327. As we record that, the unrecorded amount goes down. The carrying value of the liability will be pulled down towards par over the life of the bond. So again, note the dates. Okay, a June 30, a full 6 months, $1,067,327 times that market rate divided by 2, 8 divided by 2. We've got interest expense, $42,693, less than the coupon paid, $50,000. Why the difference? Oh yeah, amortization of the premium. The premium, $7,037. Of that $67,000 unrecorded gain, we just recorded $7,037. Subtract the $7,037, the carrying value of the liabilities, now $1,060,020 times constant rate, effective interest method. Interest expense, now $42,401. As the carrying value of the liability went down, what happened to the interest expense? It went down with it. Still less than the coupon paid of $50,000, no change. Now we just recorded how much of the gain? $7,599. How did we record that gain? Implicitly by reducing our expenses. Okay, we do this every 6 months for the 4-year term. All righty. So with the effective interest method, no change in the rate. All right, the market rate at issuance, 4%, the 8 divided by the 2. There's your interest expense, less than the coupon paid. Difference is the amortization, the $1,067,327. We just recorded $7,307 of gain. Carrying value got pulled down. Woo, baby, we are kicking ass. So as your carrying value gets pulled down, your interest expense is getting pulled down. The rate is constant under the effective interest method, but the interest expense is being pulled down because the carrying value is being pulled down. Any difference between the interest expense and the coupon paid, that is amortization. Subtract the amortization, pull down the carrying value of that liability, such that at maturity, it'll be what? $1 million. We will repay that. That'll be financing outflow, that one-time principal payment. That's why we use the present value factor of 1 for the principal, yet the present value factor of an ordinary annuity, because we have multiple payments for the coupon. Sweet. Now my journal entry, debit interest expense. That'll make your net income go down, your retained earnings go down. Equity just went down, my little balance sheet. Equity just went down by $42,693. Yet I'm writing a check for $50,000. That makes your assets go down by $50,000. Something doesn't balance. Oh yeah, what's your plug figure? The premium on the bonds payable. We just recorded $7,307 of that gain. Carrying value of that liability is going to be pulled down, minus let's see, $7,307. So $7,307. There's the amortization, equity down, liabilities down, right-hand side of the equation, down by $50,000. Liabilities down, equity down, we're in balance. Now, from the flip side, you're the bond holder. You're going to debit cash for the payment received on that coupon, $50,000. Yet you're going to record interest income of only $42,693. Why is your interest income less than the coupon received? Your interest income would have been $50,000 had you paid $1 million for the bond. But because we paid more than $1 million, our yield is actually less than the coupon. So my interest income is only $42,693. To make my balance sheet balance, the premium that just got amortized from the perspective of the bondholder, that'll make the carrying value of that asset go down. That's the $7,307. So from the bondholder's perspective, your cash is up by $50,000. Okay, your equity is up by $42,693. But my balance sheet doesn't balance. Oh yeah, the carrying value of the asset just went down by $7,307. So your net change to your assets, that's only up by $42,693. Cash went up, but the carrying value of that asset is getting pulled down towards par. But that's an asset from the perspective of the bondholder, flip side of the coin. At December 31st, as the carrying value of the liability, again, from the bond issuer's perspective, the borrower, as that liability gets pulled down, the interest expense gets pulled down. The cash, no change. Plug figure, $7,599. Equity is down, liabilities are down. The right-hand side of the equation is down by $50,000. The left-hand side is down by 50,000 cash payment for the interest. Okay, the unamortized premium just went in what direction? Down. As we add a smaller and smaller unamortized premium, what's happening to the carrying value of that liability? Being pulled down towards par. All righty, we are kicking ass, baby. Notes and bonds payable. Sorry, no notes today. But now we're going to do straight line. Interest, expense, constant. All righty. Now, if the bond was issued at a discount, there's a loss. You're going to have the coupon paid plus the bad news, the amortization, because we want our interest expense to be greater than the coupon paid. If the bond is issued at a premium, again, that's good news. Well, the coupon paid will subtract the amortization because we need our interest expense to be less than the coupon paid when it's a premium. So all you got to do, step one, find me the coupon paid, and then step two, find me the amortization straight line. Take that discount or premium, divide it by the number of periods. Remember, not the number of years unless it's annual pay. There's your amortization each period. If it's a discount, you add that to the coupon paid. If it's a premium, you subtract it from the coupon paid. All righty. Remember, if it's a discount, bad news, we need the interest expense to go up. If it's good news, we need it to go down. Okay, interest expense, we have a constant dollar amount for that interest expense, okay? So, straight line method. Now, be careful. Only if, you can only use it, only if the difference between the straight line method and the effective interest method is not material. Cannot use straight line in two situations. Long term, 20 plus years is the term of that bond, or it's a zero coupon bond. The difference in the numbers is going to be too extreme when it's a long-term bond, 20 or longer years, or it's a zero coupon bond. Okay. If we do straight line, amortization is the same each period. Thus, interest expense is the same each period. Thus, your interest expense is the same every period. Just take that discount or premium divided by, if it's semi-annual pay, your number of years times 2 if semi-annual. All righty. A discount's bad news. You add the amortization to the coupon. We want that interest expense up. If it's a premium, that's good news. You subtract the amortization from the coupon because we want the interest expense down when it's good news, up when it's bad news. Nothing to memorize. You're understanding it. All righty. Now take a look at this. You ready? Straight line method. Your interest expense is constant. Your interest expense, no change. Whereas with the effective interest method, interest expense, not constant. What is it dependent upon? Dependent on carrying value of that liability. Is the carrying value being pulled up or being pulled down? Straight line method, your interest expense is constant each and every period. Okay, so we will amortize it little by little. So let's take a look at our example. Ready? Same facts as before. We offered the world a coupon of 10. The market said, now we want 12. They want more. So the price is going to be what? Discounted. So your interest expense is going to be greater than the coupon paid. This is bad news. This is a loss. My selling price is going to be less than the face value. What's our selling price again? $937,902. 1 million minus the $937,902. What's the discount we have to amortize? $62,098. That is a loss. That makes our interest expense go up. So I'm going to take that initial discount, $62,098. I'm going to divide that by, I read carefully, semi-annual, while it's 4 years times 2, 8 periods. We take that discount, straight line, just like you will with depreciation, 7,762. That is going to be the constant amortization every period. Constant amortization every period. Carrying value of that liability is going to go up every single period. My coupon paid, 50,000. My interest expense every 6 months, constant dollar amount. Interest expense will be constant. And the carrying value of the liability is going to go up every period by 7,762. You know you're adding it because your interest expense has got to be greater than the coupon paid, because it's bad news. It's a discount. It's a loss. Our selling price was less. You borrow 937,000, but you got to repay $1 million. That's awful. That's a loss. All right, and there it is. So that's it. Piece of cake, baby. So the amortization constant, you add that to the beginning carrying value of the liability every period. There's the ending carrying value, no change. The 50,000 coupon payment, no change. The 57,762 of interest, no change. Constant every single period. All righty, constant every single period. So you know you're looking at a straight line amortization schedule. How do you know? We know either way the cash payment doesn't change, but when your amortization is constant and your interest expense is constant, you know you're looking at straight line. Okay, so the cash payment plus 57,762, 937,902. What are we going to be adding every period? 7,762. Okay, carrying value of that liability is being pulled up little by little, but by a constant amount. The amortization does not change. The interest expense does not change. This is how you know you're looking at a straight line amortization. Carrying value of the liability, though, pulled up towards par. Cash payment, amortization, interest expense, all constant under the straight line method. Carrying value of the liability, though, is going up. You know your interest expense has got to be greater than your coupon paid. It's got to be greater than your coupon paid. All righty. What do we repay at maturity? There's your financing outflow. Whether the bond is issued at par, a discount, or a premium, what do we always repay at maturity? The face value, the par value. You always, I don't care if the bond was issued at a discount, a premium, or at par, you always repay the face value at maturity. Okay, so what's our journal entry? Debit your interest expense. That'll make equity go down. You credit your cash payment. That'll make your cash go down. Your assets go down. Well, my journal entry doesn't balance. What's your plug figure? Discount on bonds payable. As that contra liability goes down, carrying value of the liability goes up. So the left-hand side of the equation is down by 50,000. Equity is down by 57, but liabilities are up by 7. Left-hand side down by 50, right-hand side down by 50. We're in good shape. Notice, full 6 months, folks, full 6 months. Okay, December 31st, year 1, same journal entry. Every 6 months for 4 years. Beautiful. Piece of cake on the exam. No change, no change, no change. Carrying value of the liabilities going up every single period by the exact same amount of amortization. Your interest expense don't change. Your amortization doesn't change. Your coupon payment doesn't change. What if it were a premium? What if it were a gain? Well, then if this is the exam and it's a theory question, think, well, hey, my selling price is greater than my par value. So my interest expense has got to be less than the coupon paid. Let's pretend the selling price was that $1,067,327. Subtract the $1 million face value, $67,327. There's your premium. 4-year term, but semi-annual times 2, 8 periods. What's going to be my amortization? $8,416. My coupon paid is going to be $50, but I need my interest expense to be less than the coupon paid. So I don't need to memorize. So then you have to subtract the $8,416. What's going to be your interest expense every period? $41,584. The coupon paid, no change. The amortization of the premium, no change. The interest expense, no change. And what's going to happen to the carrying value of this liability? It's going to be pulled down. Every period, how much are we going to subtract? $8,416. Till the carrying value reaches what? $1 million, then we will repay the loan. Sweet. You got to love it, baby. You got to love it. So, interest expense. You ready? Whenever it's a premium, you think interest expense less than the coupon paid. That premium's good news. The way we implicitly record the good news is by reducing the interest expense. Carrying value of that liability's got to be pulled down towards par. Okay, your interest expense, okay, as we saw, it's going to be constant every period under the effective interest method. It does not change. All righty. Now, straight line method, reminder, when are you not allowed to use it? When the term to maturity is long. They'll make it obvious. Okay, if it's 20 years or more, straight line is not going to be allowed. They won't make it 18 years. They'll make it 5 years or 25 or 30, whatever, they'll make it obvious, okay? Because the difference is more than minor. It's a significant difference. You can't do it. What's the other situation you can't do it? When we have what? A zero coupon bond. Okay, when there's a significant difference between the market and stated rates. With a zero coupon bond, the coupon is zero, and let's say the market rate, they're demanding 8%. Well, that's a hell of a lot more. You're going to have a deep discount. Your selling price is going to be way below that par value, a deep discount. Now, are you still going to record interest expense? You bet. We're accrual basis, not cash basis. The entire discount, that loss will be recorded by little over the life of the bond. We're going to record. How do we always record interest expense? Beginning carrying value of the liability times the market rate at issuance. So you're still going to amortize and record your interest expense despite the fact the coupon is not paid. Okay, one payment at maturity, that's it. Okay, bond premiums and discounts. When it's a premium, the carrying value of the liability's got to go in what direction? Down. How do you know it's a premium? The selling price was greater than the face value. Your interest expense less than the coupon paid because it's good news. Coupon divided by price, the market accepted a lower rate, so the price is a premium. A discount, carrying value of the liability be pulled up towards par. A discount is a loss. Your selling price is less than the face value. They said, hey, you're offering a coupon of 10, no way, we want 12. Par value, price of that bond is going to be pulled down below the par. Your interest expense going to be greater than the coupon paid. We got to record that loss. All righty. So nothing to memorize, we think. All right, how we doing on time? This is time. Can you imagine? You would think I've done this before. Beautiful. Zero coupon bond. I can't give away the entire course. I'll get shot over here. So hopefully this is now starting to register. All kidding aside, this is an illustration of what myself, Roger, who's amazing, Megan is amazing, Suzanne, Greg, I mean, you're talking PhDs, people who write books, people that have actually worked in public accounting. What a novel idea. You know, as people trying to teach CPA review who've never worked a day in public accounting. You got to beware of somebody trying to teach you audit or tax that's never worked a day in public accounting. That would make me nervous. But you're talking the best of the best. What we do is in the lecture, explain this. Now you'll take this. You'll do your practice questions, your multiple choice first, your task-based simulations. Then we periodically get together and have live webinars where there's no walking through the theory anymore. No. Now it's all practical application, multiple choice and task-based simulation that we do together. Because we want to make sure, even if you're getting it right, are you getting it right for the right reason and in the time period allotted? If a multiple choice question is answered correctly, but it took you 10 minutes, that's not a good thing. And sometimes if a multiple choice is answered correctly, but it took you 3 minutes, Maybe it could have taken 10 seconds. The coupon equals the market rate. They give you all the present value factors. It's all distractor. If the coupon equals the market rate, the bond is issued at par. I don't need to do any math, right? Two people get it right. One person takes 15 seconds. The other one takes that other course and it takes 3 minutes. You don't want to have that happen. Last thing I'll leave you with before I jump ahead all the way up here. Folks, you got to slow down to speed up. What do I mean by that? Folks, when you go through the lectures and you have a thorough understanding of the subject matter, then it's much easier to go through your multiple choice and task-based simulation. If you rush through, then your questions become that much harder, folks. So slow down to speed up. And last thing, how long is every part of the CPA exam? 4 hours. You got to be accustomed to sitting down 4 hours uninterrupted. This is what's awesome about Megan, Roger. These are people, Suzanne, Gray. You want to watch. You don't mind, because these are exciting people that know what they're talking about, and then explain it in a way. It's like, oh yeah, the light bulb goes off, because this is not rocket science, folks. No one here is going to talk to you in a condescending way. As smart as Megan, Roger, Greg, Suzanne, these people are, they talk to you like this. This is what it is. This is not rocket science. If it was, forget it. I could have never passed. Isn't that right, Megan? Who's got the lowest IQ of anyone you've ever met? Come on, Megan. I know it's me.
I mean, I wouldn't say you, but I will say you did pass.
I did. Yes, I did. Yes. And I actually got a perfect score in audit. That's the only section I don't teach, because I got a perfect score, 75, baby. Everything else, I enjoy the math, you know, the audit theory kind of. And when I did audit for a living, it was amazing. I always busted the budget. I was like, how did anybody do all that testing in 7 minutes? Shit, that's taking me 7 days. But story for another day.
I mean, there's a reason you're not working as an auditor.
What happened?
There's a reason you're not currently working as an auditor.
Oh, yeah. No, I won the award at Deloitte for the world's worst auditor. They gave me that award as they gave me a boot out the door. I didn't get fired. I left to go to law school. Madeline, did Quinn ever join us, or did he go out last night? Where'd he go?
Yeah, you know, he's a party animal. No, Quinn isn't able to join us today, but no problem. I actually, before we jump into any of, just wrap up, we have some questions that came in for you. Would you mind answering some?
No.
Okay, great. All right, we'll start with we'll start with a tough one. Okay. And Megan said that she's happy to be available for you if you need a phone a friend for this one. What should we do with bond issue costs? How does that impact the discount or premium?
Oh, bond issue costs. That's part of the course, baby. That's part of this lecture. If I could go back a few slides, you'll see the bond issue costs. Yeah, if you had a discount, that'll make your discount even bigger. If you had a loss, it's even bigger, right? We're going to amortize those bond issue costs. If you had a premium, it'll make your premium smaller. If you issued at par, that'll make the proceeds on sale a little bit lower. So yeah, that's part of it. But if I gave away everything for free, you know, we'd have a big problem. So yes, that is part of this lecture. That's the cliffhanger to say, man, I got to enroll in UWorld, man. So yeah, that's all laid out for you in this lecture.
Great, thank you. Okay, so now we're going to switch to some easier stuff. On the exam, are we more likely to see the effective interest method or the straight line method?
You could see either, but obviously the effective interest method, because it's technically used more often, because you can only use the straight line in certain instances. You know, but I'd be prepared for both, right? It's not all that difficult. You should be able to understand how to do either one. But if I had to bet on it, I would say the effective interest method, you're going to have a bigger, greater chance.
Got it. Okay. Will the present value factors be provided on the exam for both MCQs and TBSs? Additionally, if we have a bond TBS and we have to calculate the present value, how much wiggle room do we have on rounding?
Quite a bit, you know, with the rounding. No one's looking at tricky here. I mean, the exam is challenging enough, so there's no need to do any tricking per se. So yeah, the rounding's not going to be a big deal. I'm sorry, what was the first part of that question, Madeline?
Will the present value factors be provided on the exam
yes.
for both
present
MCQs?
Value factors will be, here's the problem though. They're going to give you more than what you need. So they're going to give you present value factors that correspond with the coupon rate rather than the market rate. They'll give you, if it's semi-annual, the total number of years rather than the number of periods. So actually, they'll give you lots of choices to choose from. You got to choose the right one, okay? We do show for certain things how to calculate a present value factor should it be needed. So, you know, story for another day, not all that difficult to do, but more likely than not with the bond question itself, time value of money, that could be its own type of multiple choice or part of a time value of money type question. But with the bonds, the present value factors, it's about what dictates the price of the bond, choosing the market rate, not the coupon, and then make sure you adjust if it's semi-annual versus annual. But they will give you more than what you need. And they'll give you both the present value factor of an ordinary annuity versus an annuity due. Rarely with bonds, I'm not saying, you know, rarely is it an annuity due. That could be leases though. With the bonds, it's generally the ordinary annuity because the coupon payments come at the end of each period.
All right, got it. Thank you. Okay, we're going to move into a few strategy related questions that came up. Do you have a recommended strategy when tackling MCQs? Do you recommend skipping to the last sentence to find out what they are asking before sifting through the information provided?
Yeah, you got to come to one of our webinars where we do the practice questions, you know, rather than this was, again, illustrating how we go through the notes. But yes, when it's you know, a paragraph worth of information could be like that first line, $1 million bond was issued on this date with this coupon rate, this number. It's like, oh my God, all of a sudden. So what I always like to do, I call legalized cheating. Those of you who know me, I like to start with the question stem so that I can see what information is going to be relevant given the formula necessary, and then I will read in context. So I always find it to be very helpful, unless it's like a 1 or 2 line question, you know, then you could start at the top. But anything math intensive, that's part of what we do in the webinars. That's the strategy. I don't doubt your ability to do the task-based simulation, right? My concern is the timing. So how is it that people can take a question that's going to take some people 30 minutes? How does somebody do that in 15 or 20, right? That's part of what we do. So reading the question stem first. If it's a task-based simulation, don't read the facts. Don't look at the exhibits. It's overwhelming. Relax. Go to the questions. Let that prompt you as to what's going to be relevant. Then you read the facts and context. So Megan does an amazing job at that. It's logical. It's not rocket science, but it takes practice. I tell people task-based simulations would be challenging even if it were an open book exam because of the volume of information that's thrown at you. And they love giving you surplus information that has no bearing on the solution, right? So a lot of this takes practice. So that's why the course involves both, you know, going through the lectures, reviewing the content, but then how do we apply that, right? So you got to do some of that on your own. Some of you do with us.
Thanks. Great. Okay. Do you have a recommended strategy for TBS?
Yeah, yes. Oh, you know what I would, in addition to what I just said, you know, I would never practice task-based simulations until you've done your multiple choice first, because as I mentioned, even if it were open book, right, it's challenging. It's obviously not open book. So that adds to the level of difficulty, right? So you don't want to practice task-based simulations, in my opinion, until you've done your multiple choice, corrected your mistakes, and then you feel really comfortable with the subject matter so that you can then navigate the volume of information. But I'll tell you, one of the things that's unique about UWorld that I love about this product, the SmartPath, which I think you'll talk about, but the SmartPath technology, you know, people, you know, think they got to work hundreds of questions. No, you're spinning your wheels, man. It's a sweet spot between the number of questions you work as well as the percent correct. So I tell people, if you say, Pete, I got 100%, but you only work 10 questions out of 300, I'm not very impressed. Or if you say, Pete, I worked all 300 questions, well, your percent correct was only 50, I'm not very impressed. So we want to find the sweet spot between percent correct and the volume you work. And then you can take that information. Now you know I'm ready to move on. Now I could apply this to my task-based simulations, okay? But you got to make sure, slow down to speed up. Overall, you'll spend less time if on the front end you're mastering the concept rather than when people ping me on LinkedIn and they're looking for shortcuts. You're looking for shortcuts. If you're studying to get a 75, that's not good news. You could get a 75, but if you have a bad day, that'll be a 65. We're prompting you. We are preparing you to study for an 88 so that if you, in your opinion, bomb at exam day, well, that 88 you didn't get, you got a 78 instead. I'll live with that.
Yeah, that's a really good tip. Okay, while we're actually talking about time management on the actual exam, this question came up. For FAR specifically, is there recommendations for minutes per question, time per section, and whether to skip difficult questions in multiple choice and then come back to them later?
Well, for the most part, right, your first 2 testlets are multiple choice. Your last 3 testlets are task-based simulations. Now that's 2 to 3, yet point value wise, multiple choice of 50%, other than ISC where it's 60% of your questions are multiple choice. Other than ISC, every other part of the exam, 50% of your points are for multiple choice, 50% of your points are for task-based simulation. So just as a benchmark, that'll give you approximately 2 hours for the first 2 testlets, approximately 2 hours for the last 3 testlets. This is why practice exams are so important. Practice exams, ironically, you're going to practice the information, obviously, but it's more about allocating, right? The timing between your individual testlets. So look, you're looking on average, whatever part of the exam you're looking for. Go to our website, you'll see the total number of questions per testlet. Take your 120 minutes, divide that by the number of multiple choice for any section you're taking for the exam. It ranges, but it's generally around a minute and a half. But as you know, I always tell people, ironically, even though that's the average, rarely does a question take a minute and a half. Like it's either theory-based multiple choice, the remembering and understanding type of skill level, that look, it's going to take 10 or 20 seconds. You either know the definition or you don't. Get it right quickly. But if you're going to get it wrong quickly. All right, let's not take a minute and a half on something. You got to guess. It's okay. But you want to allocate that time for more math-intensive questions that are going to take closer to 3 minutes. When it comes to strategy, if you remember nothing else from today, have this repeat in your mind. When in doubt, move on. When in doubt, move on. You work a math-intensive multiple choice question. It takes you 3 minutes. You get a number that's not one of the answer choices. Move on. Because it is very possible that that question, best case scenario, counts toward your score, you get it right, but all of a sudden that 3-minute question became 5 or 6 minutes because you did it a second time and now you got the right answer. Let's say it counts toward your score, great. But you know what I'm going to tell you? Your body clock's going to tell you need to speed up. You just spent 6 minutes and you know you have an average of, let's say, a minute and a half. You start to rush. What would have been easy becomes difficult. And that's best case scenario. Can't have that happen. Worst case scenario, you work that question twice, you get it right, and then it doesn't count towards your score. There are pre-test questions exam day, multiple choice that don't count, a task-based simulation that doesn't count. They're there to develop future exams. So when in doubt, move on, okay? When you do your practice exams in exam conditions, practice your time allocation, watch your clock. Testlet number 1, testlet number 2, you got to be done with the multiple choice in less than 2 hours. You got to generally have more than 2 hours for your 3 task-based simulations, your last 3 testlets. When you do your task-based simulation, you guys know there could be 2 or 3 problems, every section of the exam generally, 2 or 3 problems within that testlet. Do not work them necessarily in the order they're provided. Why not? Because you got to legalize cheating, man. Look at the 3 questions, work them from easiest to hardest. If God forbid you're going to rush and run out of time in a testlet, let's rush and run out of time on your weakest topic, not your strongest. I mean, these are the things like we really hit home on when we do the practice exams and we do the seminars. You know, when we do the what do we call them again?
The boot camps?
Boot camps, yes. Okay.
Yeah.
Boot camps.
And we could talk about that in just 1 minute. All right, one last question, and then we can get to our ending. All right, this goes away from our lecture today, but I do think it's a good question to address. Between BAR, ISC, and TCP, which is easier to pass content-wise, personally.
Oh, come on, man. Come on.
I know. This person says, I like BAR, but there seems to be less content on ISC.
Oh, listen to me. You pay for this stuff. This is going to change you, your career, your knowledge, your value. Don't, again, stop looking for shortcuts, man. You pay too much for the 5-year damn degree, 150 grand. Get your money's worth. If you go audit and you're an IT person, do ISC. If you're audit, but you're not IT, get the technical expertise in consolidations and leases and the derivatives, governmental and not-for-profit. Get your money's worth. And if you're a tax person, you take TCP. Look, the AICPA is not stupid. They know that people are looking for shortcuts. You think they're going to have a pass rate of 80% in ISC, but then blast people in BAR and give them a passing rate of 40%? Ain't going to happen. All right? They can't do that. People will start choosing. They don't want the discipline to be chosen based on level of difficulty, but I get it. Here's the deal. Bar has more information. Look, it's more advanced level accounting. It's your derivatives, your leases and consolidations or whatever. But there's a lot of overlap between FAR and Bar. But here's the deal: there's going to be a curve, man. If the questions are more challenging, why don't they just give you a raw score? Certain questions don't count. And look, I don't know. It's machine graded. It should happen instantaneously, but they don't. They look at the performance. They know where they want the passing rate to be. So if it might be a little bit more challenging topic, you know what? Maybe, there's going to be a less expected of you in terms of raw score, right? ISC, the good news is no math involved. Get through that more quickly. You know what I found the hardest in every exam, bar, CPA, CFA? Theory questions sometimes could be killers, man. It don't add up. So, choose it based upon your career path, man. TCP, if you're a tax person, all that excellent information on financial planning, high net worth individuals, entity. H&R Block crunches out tax returns, man. You make your money by the financial planning. Let's lawfully avoid unnecessary taxes. Let's pass that wealth on to me without giving it to the government in the form of estate taxes. How do you put together that plan? Good information. Get crazy and kind of like this stuff like Megan. You got to get into this, man.
Absolutely.
I love it.
All right.
Over here.
Oh, you're doing great. All right, I'm going to actually just take over this.
No, I'm not. Oh no, maybe I am. I'm sorry. Go ahead. I'm sorry. Well, I was on video when I did that. I'm sorry.
That was for all the world to see. I'm going to just take over really fast. Can you see my screen?
I can see it. You got lots of icons up there.
Icons?
Yeah, I got all your little thingies.
Oh, you want to see the screen? Nobody wants to see my desktop.
There you go.
There we go. Now,
you want me to flip through it for you? I can flip through it for you.
I got it.
Before she does this, somebody wants to know if now that MCQs have reduced in number, are there still pre-test questions?
Yeah, of course. There's always going to be pre-test questions, and there are always questions, regardless of pre-test or not, that for one reason or another they might throw out because there's a glitch. Too many people got the incorrect answer. Something wasn't right about it. So yeah, test-based simulation, same thing. The number of questions, even though there's less multiple, the reason is less multiple choices. Really, this AI CPA was trying to meet what the firms were saying. It's too much memorization. People who have 3 or 4 years in audit experience should not be disadvantaged on the audit section of the exam. That's disgusting. Like if I've been doing audit for 3 or 4 years, you should have an advantage. So they want it to be more practitioner-based, cut down the multiple choice, remembering and understanding, and have it be more of analysis, evaluation, etc. Same thing with tax. They want to cut back on the memorization and have it be representative of what you'll see in practice, so that if you do have work experience, it works for you, not against you.
Great. Thank you. Thank you, Pete. All right, folks, we're just going to run through this really fast. We're so glad that you were all here and able to join us today. I hope you got a lot out of it. That's what I saw in the questions come in. Great questions. Thank you, Pete, for your fantastic lecture, and for Megan helping out in the background, answering all of your really difficult questions.
Go, Megan!
Yeah, Megan's the best. Megan is the best. So I just want a quick recap. 2024 product, it came out late last year, and people are really enjoying it. One of the biggest things that you saw today in the presentation, if you notice, a lot of times the representative task comes up. Everything that we do in this program is mapping back to the AICPA blueprints and ensuring that you are learning and practicing and honing in on exactly what the AICPA is asking you to do. And it's going to be very clear to you as you're working through the program, what tasks do I need to be able to demonstrate my knowledge and my skills as you're going through. So everything that we've done is built around that with our team of fantastic experts, including Peter Olinto and Roger Phillips, some industry favorites, as well as our just full team of experts, including Megan. You'll see her here. She's on the screen, but we have a whole stacked panel of fantastic experts in different areas that are working in all the different sections. And as Pete said, there are a lot of great instructors
Real
in here
industry
too.
experts, real, like
Real industry.
tax people wrote the textbook on tax. Suzanne and Greg wrote the textbook. Megan is very accomplished, but very humble. PhD. I mean, these are people like this is their lives. Public accounting, academia, like they know what they're doing.
Yes, absolutely. And they've worked in the industry. They have been practitioners. They're experts, educators at top universities. So you are just in really good hands. Okay. And then what we were just showing here was this is an example of the blueprint. And then you'll see here how this is a sample from our book, how we point out directly within the textbook what it is that you're doing. So that's just showing you a little bit of that mapping that you see in the program and then in our sample questions. So the sample questions, when you go through, our answer explanations. And as Pete said, these are the best in the industry, meticulously written. Megan, what was it that you said yesterday about hours per question and how much time you spend on the question?
People ask us how many questions do you write per hour? You know, it's actually the reverse for us. How many hours do we spend per question, right? So it takes us a lot of time to get here to these answers, these explanations.
Very in-depth, helpful illustrations for those of you who are visual learners. And then again, the mapping to the AICPA blueprints is very clear in every question that you see, and easy access to wherever you are in your program. So if you are, whatever lecture it is that question is testing you or testing you on, and if you need a little bit more explanation, you can go right back to that section in the book or the lecture if you want to rewatch it right from the question. So every question can be treated as a learning experience. And SmartPath predictive technology really helps you stay on track, know where your strengths and weaknesses are. This is the one thing I tell students in our course that maybe they're in there, but if they're not utilizing this, they are not getting everything out of the program that they can. So if you are already in our program or looking to become a person in UWorld, definitely take advantage of the SmartPath technology that really helps you stay on track. There's targets that you can see very clearly for each section, and your job is to meet that target. And it's kind of what Pete was saying earlier. There's a perfect match between the quantity of questions that you see and how you're performing on those questions. And you want to hit those targets on both. You don't want to hit it on one or the other. You need to get both in order to be at an exam ready spot. And then just to keep you on track, we talked about time management on the exam today, but it's also really important that you are keeping track of your time and staying committed to your schedule as you're working through the program, that you have a consistent study schedule that meets your individual needs. So our dynamic study planner, you can choose the days you want to study. You can choose how many hours you want to study. And then on the other side of it, you will be provided with a study plan that you can stick to. And if you miss a day, you got to make it up. Or if you want to adjust your schedule, you can do that too. So this is to help keep you on track throughout. So again, if you're a current student, please take advantage of this tool and get all that you can and make sure you hit exam day. Ultimately, our package, we have the full package. You have access in the Elite Unlimited course. You'll choose the discipline of your choice. So you have access to 4 sections complete. We have over 8,000 questions, all new textbooks, all new instruction to make sure that you are prepared for the 2024 exam, mapped to the AICPA blueprints. And then, as mentioned, the live boot camps. So what you saw today, this is one of our free live lecture webinars. And now we also have live lectures within the program. So if you're in one of our elite packages, you will have access to live lectures with our different instructors on the core sections of the exam. And we have unlimited access as well, which means that basically you have access to the program until you pass. More of these live lectures coming up. If you want to snap this QR code, coming up next, we have July 20th leases, and then September 28th consolidations. Pete, you jump back on. Is there something you want to say about these?
I can't wait, man. I'm ready to jump right in, do leases right now. Well, bond issue costs, man. I wish I could do it all. You know, we got to talk. I think these should be longer. People type in, we will be responsive. If you want this to be 3 hours rather than 2, I'm in.
I mean, I think Pete goes with 5-hour energy. So you still got a couple hours of Pete's energy level, right?
You know it.
So our good friend Quinn wasn't able to join us today, but if you are working with a firm and are interested in whether or not we have a direct bill partnership with your firm, or would just like some help walking through the program, please contact Quinn. He has made himself available for demos. Reach out. Please take advantage of that. And finally, we know a lot of you here are our current students in our program, and we're so happy to have you here to help continue to add value to your study program. But if you're not one of our students, we'd love you to join us. You can try it for free. We do have a 7-day free trial, so you can, that first QR code on the left will give you access to that. Or if you just know that this is the program for you, and I can tell you that it's you'll get a lot of what you saw today and access to all those great features that we just went over. But we do generally have some discounts running. So if you want to see the latest discount that's available, you can see that there on the one on the right. Also, if you are a student of another CPA review program, we do have our Fresh Start discount that's available to those who are looking for a different approach. It's a really great discount, so you can see that there in that link as well.
The CPA landscape has changed, folks. Don't just ask people what course they took. Things can change rapidly, and I mean rapidly. Like, we are a consolidation of Roger, the best in the business, the UWorld folks, Megan, best in the business, the Wiley folks, and I've recently joined. So when you talk to somebody saying, oh, what course did you take? That course they took that they like so much, ask them what they like so much about it, because things could change rapidly, and they have. And listen, the firms, we are doing a ton of stuff with the firms now. So little by little, as they get the ability to join forces with UWorld, they know where the best in the business is. And I kid you not, this team here is second to none and passionate. Everybody cares about your success. So I think you're in a great place. You choose UWorld.
Thanks, Pete, and we couldn't agree more. We're so happy to have you here today. I know some more questions flew in as we were wrapping up. We can answer them directly. We have, through the email that you registered for this presentation today. So we will reach out to you afterwards. But join us for the next one. Join us in the course, and happy studying to you all, and happy Saturday.
Let's go! See you guys in leases. Megan, thank you. You're the best. Megan's the best.
Anytime, Pete, anytime.
All right. Thank you all. Take care.
See you guys.